The paper market tried to fake you out this week. Gold and silver were supposed to stall. They were supposed to roll over at those so-called double top levels everyone kept calling the peak. Instead, both metals punched straight through and printed fresh highs. That is the signal. The run is not over. It is accelerating. Welcome back. I'm Jon AG, and you're watching the Currency Academy. Here's what actually happened, fast. The market spent weeks staring at two price zones from late December. People treated them like a ceiling. A bunch of analysts said, "That's the top, sell it, it's done." Then the weekly close arrived, and both gold and silver closed above those zones, clean. Not a wick, not a tease, a close, and then they extended higher anyway. And silver? Silver just pulled a move that almost never happens. Even after giving back some gains late in the week, it still finished with a monster weekly jump. That kind of week is rare for a reason. When silver starts moving like that, it's not behaving like a sleepy metal anymore. It's behaving like a pressure valve about to blow. Now here's the part the charts alone won't tell you. This breakout isn't happening in a calm world. It's happening while stocks are at record highs, while the tech narrative is still loud, while the headlines are still pretending everything is fine. That's exactly when gold and silver become dangerous. They start rising while everyone is distracted. If you want the clean takeaway, it's this. Gold is acting like a reserve asset again. Silver is acting like a shortage asset again. And when those two wake up together, history says the next phase is fast. But before we jump into targets, we need to clear up a trap that's already spreading. People are comparing this move to the 2011 blow-off top. They're saying, this is the end. We're right back there. No, this is not 2011, not even close. Let me show you why, and then I'm going to show you the levels that actually make sense in this kind of cycle. Back in 2011, the move was powered by panic. The financial crisis was still fresh. The system was shaking. Confidence was thin. Europe was a mess. Bond markets were screaming. And money was sprinting into anything that felt solid. That is why gold ran so hard. That is why silver went vertical. Today, we haven't had that full public panic moment yet. We've had stress, we've had cracks, we've had pressure, but we haven't had the moment where normal people look at their screen and realize the rules changed overnight. And when that moment finally hits, it's going to be bigger than 2011. Because the world is not cooperating like it used to. The old safety net was coordination. Back then, major players were willing to step in, buy debt, calm the fire, and pretend the system was stable. That era is fading. Now you have fragmentation. You have selling pressure. You have competitors, not partners. So what fills the gap when cooperation disappears? Printing, digital liquidity, emergency tools with new names and the same outcome, more currency units chasing the same real assets. And that's why the 2011 comparison misses the point. 2011 was an early warning shot. This cycle is the full movie. Now let's talk about the other key difference, interest rates. Cycle tops in gold and silver almost never happen before rates finish their move down. The metals don't need rates at zero to rise, but they do tend to make their wildest finales after policy has already swung easy. That's when confidence breaks, currency weakens, and hard assets start acting like lifeboats. So if the expectation is more rate cuts ahead, even if the timing is messy, that alone argues against calling the top right now. The story is still unfolding. This is where a lot of people get fooled. They see a strong run, and their brain tries to anchor to the last peak. It's a comfort move. It feels safe. We've been here before, so I know what happens next. But markets don't repeat perfectly. They rhyme, then they improvise. Here's the framework I want you to use instead. Don't just compare this cycle to the US dollar chart. Benchmark gold and silver against other currencies too, because the US dollar is not the whole world. It's one lens. When you look at places like Canada, Australia, Japan, and other developed markets, you see something important. Gold has already pushed much further beyond its old highs in several currencies than it has in US dollar terms. Silver has also moved, but it still has room when you compare it to those same foreign reality benchmarks. That matters because it tells you something uncomfortable. The catch-up trade is still on. If the foreign currency version of the story keeps becoming the American version of the story, then what looks expensive in dollars today may still look cheap in hindsight. So what levels do we talk about without getting lost in fantasy? First, understand the psychology. In the early and middle phases, gold tends to lead, then silver tends to chase and overshoot. Gold is the big ship, silver is the speedboat. Gold moves first, silver follows, and then silver does something reckless. Now add the fuel. Currency debasement, policy easing, higher geopolitical risk, tariff fights, resource competition, a world that feels less stable each quarter. This combination is exactly what drives metals. So let's put numbers on it. If gold continues the path that other currencies have already hinted at, then the next major psychological zone is the multi-thousand area. The market loves round numbers. It loves headlines. And the moment gold begins pressing into those big milestones, the media tone will flip from ignoring it to obsessing over it. That is when the crowd shows up. Gold doesn't need the crowd to rise, but when the crowd arrives, the candles stretch. In that environment, a move toward the next big level is not insane. It's aligned with how these cycles work. And silver? Silver is even more straightforward. Silver's job in a mania is to move fast enough to shock you. Silver has already reminded the world it can move double digits in a week. That is not normal. That is a warning label. Now imagine a year where gold keeps pushing, money keeps loosening, and the public starts waking up. Silver doesn't politely climb. Silver gaps, squeezes, and punishes hesitation. So yes, you can make a case for silver pushing beyond the last cycle highs in a way that feels impossible right now. A 6-figure price per ounce sounds like science fiction to people who haven't lived through a currency confidence event, but markets price in fear faster than they price in stability. Here's the reality check though. You don't need silver to hit some absurd number tomorrow to understand what's happening. You just need to understand that if silver replays its classic behavior, it can go far enough to change your life if you're positioned. So the question becomes, how do you position without getting chopped up? This is where I want to talk to two different people at once. If you already own metals, your biggest enemy is not the market, it's your nervous system. Because the next phase, if it's a true bull run, will be volatile on purpose. It will spike, then slam, then spike again. It will be designed to shake you out at the worst possible moment. And if you're new, your enemy is hesitation. You'll wait for a pullback. You'll wait for confirmation. You'll wait for the perfect entry, and the market will sprint away from you. So here's the balanced approach. Don't chase like a maniac, but don't freeze either. A steady buying schedule beats a panic buy at the top. A plan beats a mood. Now I want to pivot to the part nobody wants to talk about, because it's not just about price targets. It's about access. Because what if you want to buy and the system says no? One of the darkest shifts happening quietly is the rise of soft capital controls. Not a law that screams at you. Not a headline that says, you can't own this. It's subtler. It's a bank delay. It's a wire that doesn't go through. It's a phone call where they suddenly want to verify your purchase. It's a policy that magically appears the moment too many people try to exit at once. And this is not theoretical. Dealers and clients have reported banks refusing or blocking transfers to precious metals businesses, claiming they are protecting people from fraud. Yes, scams exist, that's real. But blanket restrictions are not protection. Blanket restrictions are control. Think about it. If you move your wealth into physical metal, the bank loses leverage over you. They can't earn fees the same way. They can't gate your spending the same way. They can't freeze the asset with a click. So if the currency system is under stress and too many people try to leave, the system's incentives get ugly. This is where I want you to pause and really think. Do you believe a stressed system gives you more freedom or less? Now ask yourself this. If the next phase of this metal's move is as violent as it looks, do you want to be the person rushing at the door while the door is getting smaller? This is why I keep saying the biggest threat to late buyers won't be a ban. It'll be price and friction. And we've already seen the blueprint in other regions. In parts of Europe, buying silver often comes with heavy value-added taxes that stack on top of the spot price. That means the real cost to acquire physical silver becomes dramatically higher than what you see on a chart. So you might look at spot and think, that's manageable. Then you go to buy and realize the actual entry price is something else entirely. That tax wedge changes behavior. It pushes normal people out. It makes every ounce you already own more valuable on the secondary market because replacement cost is higher. And it creates a world where silver becomes a luxury item instead of a savings tool. That's what I mean by being priced out. Now, I'm not telling you to go all in. That's not responsible. I'm telling you to think like an adult in a world that is getting less friendly to savers. Even a small allocation, even a modest position can matter a lot if the currency keeps losing purchasing power. And here's the uncomfortable math. Most households do not have limitless spare cash to save. They have budgets, they have bills, they have limits. So when metals rise, the number of ounces people can accumulate in a year can collapse, even if their income stays the same. That is how a market quietly locks people out. Now let's address the question I keep seeing everywhere. What about the banks? What if the big players lose money on shorts and get bailed out? Here's my answer. Bailouts are a feature of the modern system. They are not rare events. They are policy tools. When pressure builds, authorities choose stability over morality. But the bigger point is this. The banks are not a single unified character. They are a collection of desks, strategies, and timelines. Some players are short, some players are long, some players hedge, some players flip. And when a move becomes obvious, the smart money stops fighting it and starts riding it. So if you're waiting for a bank bailout headline as a reason to doubt the metal, you're focusing on the wrong thing. The real driver is scarcity and confidence. Gold moves when confidence breaks. Silver moves when scarcity becomes undeniable. And both are moving right now. Let me make this practical. If you're holding metal, don't get hypnotized by daily candles. Watch real-world signals. Watch premiums. Watch availability. Watch delivery delays. Watch how often out of stock appears. Watch how governments talk about resources. Those signals usually change before the chart admits the truth. Now, I want to drop 2 quick questions for you because your answers tell me how awake the audience is. First question. Do you think the next phase of this metals run is driven more by inflation or more by a confidence event? Second question. If your bank restricted transfers for precious metals tomorrow, would you be shocked or would you consider it inevitable? Drop your answers below. And don't forget, subscribe to support the original work. And if you're part of the movement against copycats, comment Jon AG best so I can see you. Now, here's the part that most people miss. When gold moves, it pulls attention. When silver moves, it pulls behavior. Gold can rise while people watch. Silver rises and people act, because silver feels attainable until it doesn't. The moment silver starts running, the public thinks, I can still get some. Then the next move hits, and suddenly the thought becomes, I should have bought yesterday. That is the emotional engine of a silver surge, and that surge is exactly how you get the kind of levels that look insane right now. Not because the metal became magic, but because the currency became weak. So what do you do from here? You keep your plan. You keep your time horizon. You remember that volatility is not a signal that the thesis broke. Volatility is the weapon they use to steal your patience. And you stay alert for the moment the tone changes. Because when the mainstream starts promoting gold after it already ran, that's your clue the public is arriving late. When your friends who never cared about metals suddenly ask you where to buy silver, that's your clue. The next phase is hot. When the headlines go from mocking to praising, that's your clue sentiment is shifting. And when sentiment shifts in a tight market, the squeeze gets violent. So yes, I expect higher prices. I expect big swings. I expect attempts to scare people out. I expect more friction from the financial system. And I expect many late buyers to get blocked by a combination of price, taxation, and policy. That's why your best move is not panic. Your best move is preparation. This week was a confirmation. It was the market telling you the breakout is real. The next question is whether you treat it like entertainment or like information. Because the window where metals are both available and psychologically ignored does not last forever. So here's the playbook if you want to stay ahead of this without losing your mind. First, stop treating metals like a lottery ticket. Treat them like a savings system. Decide a budget that is realistic for you and split it into smaller buys. That is how you build a position when the market is noisy. Second, understand the 2 prices. There is the screen price and there is the real world price. The screen price can be smashed in seconds because it is paper and leverage. The real world price shows up in availability, premiums, delivery times, and how fast products disappear. When those signals stay tight, even on red days, that tells you the selling is mostly fake. Third, don't let the timeline trap you. People say, if it doesn't happen this week, it won't happen. That is how impatient money gets harvested. Cycles don't move on your schedule. They move on the schedule of confidence, policy, and liquidity. The breakout you just saw is not the end of the story. It is the beginning of the next chapter. Fourth, know what you're buying. Gold is the foundation. It is the reserve asset. Silver is the accelerator. It is the squeeze candidate. Gold keeps you stable. Silver gives you upside. If you only chase the wild card, you will panic. If you only hold the foundation, you may miss the rocket. Balance wins. Fifth, be ready for the emotional warfare. The same week silver jumps hard, you will see stories saying the rally is dead. The same day gold makes a new high, you will see a headline about a coming crash. They will try to break your confidence, so you hand your position to someone with stronger hands. And finally, watch what governments do, not what they promise. If they start talking about strategic resources, critical materials, emergency powers, or consumer protection around purchases, that is your warning. It doesn't mean disaster tomorrow. It means the system is preparing tools for later. This is why getting positioned early matters. Not because you want to brag, because once the crowd arrives, the cost of entry changes. Premiums rise, taxes appear, transfers get slowed, inventory dries up. The same ounce that feels easy to buy today can feel impossible to replace later. If you got value from this breakdown, hit the like button so it reaches more people who need the warning, and subscribe so you don't miss the next update. Stay smart, stay calm, and protect your future. Take care of yourselves, take care of each other, and I will see you in the next video soon.